Canadian snowbirds and US taxes. Staying out of trouble. Hey snowbirds, thinking of trading your shovel for a golf club this winter? Before you head south, let's talk about something that could land you in hot water. US taxes. Welcome to the channel. My name is Anthony Gismondi. I'm a Senior Wealth Advisor with Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. Canadian snowbirds and US taxes, what you need to know. Just because you're Canadian doesn't mean the IRS won't come knocking if you spend too much time in the States. Yep, even without a green card or US citizenship, you could be seen as a US resident for tax purposes. That means filing returns with the IRS and potentially paying US tax on your worldwide income. So how do they decide if you're a resident? There are two main tests. Number one, the calendar year test. If you're in the US 183 days or more in one calendar year, you're a US tax resident. Number two, the substantial presence test. This one's trickier. It looks at how many days you've spent in the US over the last 3 years. Here's the math. All the days this year, plus 1/3 of the days last year, plus 1/6 of the days 2 years ago. If that total hits 183 days or more, congrats, you're a US tax resident, whether you're meant to be or not. Take Marco and Louise. They retired in 2018, bought a condo in Arizona, and spent every winter there from November to April. In 2021, even though they were only in the US for 151 days, their total weighted days over 3 years hit over 226. Boom, they triggered the substantial presence test. But don't worry, there are ways to stay out of IRS territory. Option 1, the closer connection exemption. If you were in the US fewer than 183 days this year, but still triggered the 3-year test, you can file IRS Form 8840. This tells the IRS, hey, I may visit often, but Canada is still my home. You'll need to prove your ties, things like where you live, where your family is, your car registration, voting status, and where you earn your income. Option 2, the tax treaty exemption. If you were in the US more than 183 days in a single year, you'll have to file a full US tax return. But you might still be able to dodge double taxation using the Canadian-US tax treaty, filing Form 8833 to claim you're still more connected to Canada. Here are some quick tips to avoid US tax headaches. Stay under 122 days per year. That's the magic number to fly under the IRS radar. Track your days carefully. Even a 1-hour grocery trip counts. Exceptions exist, like medical stopovers, but don't count on them. Remember, Canada and the US share immigration info. The US knows how long you've been there. So, snowbirds, plan smart, stay warm, and don't let taxes ruin your winter escape. For more tailored advice, chat with a cross-border tax specialist or your Wellington Altus advisor. Subscribe for more tax tips and financial advice. Thanks for watching. Safe travels and sunny days ahead.